Greetings, everybody. Welcome to Liberty Call. I'm back 2 days in a row. Woohoo! Thank you for being here. And it is, Tuesday, April 23rd, 2023. You see my big man Jake back here? Well, he's not very big. He's kind of a small Labrador. Not like Barney, my big old monster dog I used to have, who's been gone for about a year and a half. But anyways, you didn't come here to hear about my dog or my surgery recovery or anything like that, did you? You came to find out what happened in the news today. And I might cover it, actually. Anyways, all right. Like I said, hope you're having a good day. It's kind of a mix here today. It's been cloudy. It's been overcast. Now the sun's back out. It's a little chillier than normal, than it had been the last few days. But no snow on the ground right now. We may get a little more later in the week, but it's just that time of year. Spring in the mountains, you get all sorts of crazy weather. So, all right. If it's where's the camera? Yes, you. Yeah, I see you in the yellow shirt right there. If you could please give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. Whew. Still out of wind after my surgery. So if I have to stop and pause to take a breath, don't be surprised. All righty, starting out with the Dow Jones today. It was up 0.69%, 263 points, closed at 38,530. The S&P 500 up 1.17%, closed at 5069. NASDAQ up 1.59%. Big jump today. Closed at 15,696. The VIX was down 7.02%. It's at 1575. Canada up 0.64. Brazil down 0.24%. And Mexico up 0.07. In Europe, Germany was up 1.58%, the UK up 0.26%, France up 0.81%, the Netherlands up 0.96%, Spain up 1.7%, wow, Italy up 1.89%, Switzerland up 1.25%, and Portugal up 1.19%. So the last 3 or 4 big jumps today. Russian exchanges both red today. The MOEX down 1.17%, RTSI down 0.84%. And the Asian markets, the Nikkei was up 0.28%, Australia up 0.45%, New Zealand down 0.06%. In China, the Shanghai was down 0.74%, the Shenzhen component down 0.61%, China A50 down 0.02%, DJ Shanghai down 0.8%, Hang Seng up 1.92%, and the Taiwan weighted up 0.97%. All right. So at least domestically, things are in a much better mood. And I'd say the same for most of Europe, too. So I don't know why everyone's in a good mood. I mean, I know the, as they call it, the Magnificent Seven, which we're going to cover in an article here coming up, is due to report earnings this week, which are basically the 7 stocks that are holding the market together right now. Because if you took those out of the account, or if you took those out of the matrix, most stock or most indexes would be down for the year right now. So they've basically been, Hercules or Atlas holding up the globe right now over the last year or so. All right, let's get to today's market recap. U.S. stocks rally as Tesla is set to kick off earnings for the Magnificent Seven. U.S. stocks surged on Tuesday, fueled by upbeat quarterly earnings reports as investors eagerly awaited the start of the earnings season for major tech companies, including Tesla, which was set to report after the bell. So probably right now-ish. Tesla's performance was particularly anticipated as it would kick off the earnings parade for the Magnificent Seven stocks. Tesla's stock has faced recent declines amid concerns about an electric vehicle recession and a price war in the industry. However, the company was expected to focus on future prospects such as FSD, which I think is self-driving, basically. Full self-driving, I think that's what the acronym stands for, and robot taxi services during its earnings call. The market was keen on clarity regarding Tesla's plans for launching a cheaper electric vehicle known as the Model 2. In addition to Tesla, other members of the Magnificent Seven, including Meta, Microsoft, and Alphabet, were scheduled to report earnings later in the week. Market observers were eager to see if these companies could justify their high valuations through solid first quarter performance. Several companies reported positive earnings surprises, driving their stock prices higher. General Motors raised its annual forecast after strong quarterly results, leading to a 5% increase in its stock price. GE Aerospace also saw a surge of 6.7% after raising its full-year profit forecast. Spotify gained nearly 16% after beating estimates for premium subscribers, while Novartis rose 2% after raising its full-year guidance. However, not all companies fared as well fared as well in their earnings reports. JetBlue stock plummeted over 16% after the airline trimmed its annual revenue forecast due to lukewarm first quarter revenue. PepsiCo also faced a 2.2% decline after experiencing a slowdown in the U.S. Shocking, because Pepsi tastes like... Really, you really shouldn't drink sodas. I mean, I drink a few in the afternoon. I drink diet root beer that, it's from the SodaStream, their brand. So it's not too terrible. It doesn't have any sugar in it, so that's why I drink it. Meanwhile, Treasury yields retreated from recent highs as weaker than expected U.S. economic data, particularly in manufacturing and services activity, raised concerns. Investors were closely monitoring upcoming data releases, including GDP and PCE price and the PCE price index for further insights into the interest rate trends. Despite the recent decline in yields, the futures market indicated a reduced expectation for rate cuts by the end of the year. Yeah, I like I said, I've said this probably 24 times already and or more, is that I just don't expect the Fed to lower rates without a reason. Whether or not that reason is unemployment is starting to tick up significant. I mean, it has to be significant, not just it goes up to 4.5. I mean, that's not extreme. Or the stock market. I mean, it's probably going to be the stock market. That's typically, the Fed wants to help out their buddies in Wall Street. And if the stock market's taking a crap, then they're probably going to, lower rates. I don't think they'll go to zero by any stretch. But nothing's off the table. I mean, the Fed is, they're basically in the pockets of government. And I know they say that they're independent, but yeah, sure. All right, next up, let's dive a little deeper. U.S. business activity cools in April. Inflation measures are mixed. In April, U.S. business activity decelerated to a 4-month low due to a weakened demand, while inflation rates slightly eased despite rising input prices. S&P Global's flash U.S. composite PMI output index dropped to 50.9 from 52.1 in March, indicating slower expansion in the private sector. Both manufacturing and services sectors experienced reduced growth rates, leading to the first decline in employment since June of 2020, especially impacting the services industry. The survey suggested a loss of momentum compared to the first quarter, with economists estimating a 2.4% annualized growth rate for GDP in its previous quarter. Despite the Federal Reserve's implementation of 525 basis points of interest rate hikes since March of 22 to combat inflation, the U.S. economy has outperformed global peers. Yeah, well, that's because the other global nations have just inflated their currency even more than we did, so that we look better than them. It's kind of like the shortest midget or the tallest midget in the room. They're still a midget, so I could be like Shaq around them. It's no big deal. Where were we? Recent stronger than expected inflation and employment data have concerned the Fed, indicating a potential setback in its efforts to lower inflation to the target rate of 2%. As the Fed prepares for its upcoming meeting, is expected to maintain its current policy rate range of 5.25 to 5.5, with policymakers emphasizing the need for a prolonged restrictive monetary policy. The survey revealed a decline in new orders received in private businesses and a moderation in input prices, although they remained at solid rates. Manufacturing input costs rose sharply due to higher raw material and fuel prices, while service sector price pressures eased. Chris Williamson, S&P Global Market Intelligence's chief business economist, noted a decrease in selling price increases for goods and services, reflecting lower demand and a cooler labor market. Manufacturing activity entered contractionary territory, with the flash manufacturing PMI dropping to 49.9 from 51.9 in March. New orders slightly decreased, employment growth slowed, and supply chains showed signs of available capacity. The flash services sector PMI also dipped, indicating a moderation in services activity. Overall, the survey highlighted a decline in demand and a reduction in price pressures, raising concerns about the economic outlook. So looks like things are, just barely starting to slow down. So, and again, next month things could turn around. And our next article here is a report from First Trust, their data watch on March new home sales. Because if you remember a week or so ago, we talked about how, I think it was it existing homes or contract? Something in the home industry was trending back down. And then now this one says, they're trending back up. So it's from month to month, it's just very, very, very wonky. All right. So I'm just going to read this one in its, in its text. So bear with me while I jam through this real quick. All right, new home sales came in stronger than expected in March, driven by broad-based gains as more inventories give buyers a greater number of options to choose from. Notably, the 8.5% gain in March was the largest in more than a year. It looks like the upward trend in new home sales that began in 2022 as the economy reopened is still intact, though volatility in interest rates continues to play an outsized role. Mortgage rates have been surging again recently due to a recent string of bad inflation reports that have led to expectations of fewer cuts by the Federal Reserve in short-term interest rates later this year. Expect an impact on new home sales in April's report, due in a month, as higher financing costs once again hit affordability. Assuming a 20% down payment, the rise in mortgage rates since the Federal Reserve began its current tightening cycle amounts to a 28% to a 28% increase in monthly payments on a new 30-year mortgage for a median new home. The good news for potential new buyers is that the median sales price of new homes has fallen 13.3% from its peak in 2022. However, it's important to note that this drop in median prices is likely due to the mix of homes on the market, including more lower price options as developers could complete smaller properties. Supply has also put more downward pressure on median prices for new homes than existing homes. The supply of completed single-family homes is up nearly 190% versus the bottom of 2022. Total inventories have continued to climb higher as well, hitting a new post-pandemic high in March. This contrasts with the market for existing homes, which continues to struggle with an inventory problem, often due to the difficulty of convincing current homeowners to give up their low fixed-rate mortgages that they locked in during the pandemic, or in my case, 3 or 4 years before the pandemic. But this does not mean that the housing is getting more affordable per square foot. With the Census Bureau reporting median prices on this basis up 45% from 2019 to 2022, the most recent data available. Though not a recipe for a significant rebound, more inventories give potential buyers a wider array of options to continue to put a floor under new home sales. One problem with assessing housing activity is that the Federal Reserve held interest rates artificially low for more than a decade. I know I've covered that more than once. With rates now in a more normal range, the sticker shock on mortgage rates for potential buyers is very real. However, we have a strong housing market with rates at current levels in the past. And as long as the job market remains strong, home buyers will continue to adjust. In manufacturing news this morning, the Richmond Fed's Index, a measure of the Mid-Atlantic factory activity, rose -7 in April from -11 in March. All right, so that's everything that they put out there. So again, it's kind of a mixed bag. If you were hoping to buy a house at a interest rate of 2 or 3%, you probably missed that window. I mean, you had basically, the years during Black Jesus's term and then Trump's term. But once rates started going up to what we consider normal here in real life, most of us paid 5 or 7% on a mortgage a decade or two ago, and it wasn't exactly obscene. That was considered normal. So again, I feel bad for folks that were, planning on something a couple years ago, but I mean, that's just the way life is. So I don't think you're going to get much lower rates than, you might, rates may dip at some point in the future. You may be able to lock in a 5 or a 4.75 at some point in the future. But again, I wouldn't count on it. Try to pay off your house as fast as possible. That's probably my best advice for you, so that you're not paying interest to the bank or the lender. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information is there. I hope everyone out there has a wonderful evening, and I shall talk to you next time. Adios.